If you get into an accident and the damage costs less than your deductible, your insurance company pays you nothing. Not partial. Nothing. And most people don't find that out until it actually happens to them. Today, I'm breaking down exactly what a deductible is, how it secretly controls your monthly bill, and the mistake almost everyone makes when picking one. A deductible is the amount of money you agree to pay out of your own pocket before your insurance company starts covering a claim. It shows up on almost every type of policy: car, home, health, and it works a little differently depending on which one you're looking at. Let's go through it. Think of it like this. Your insurance company isn't fully taking over your risk. You're splitting it with them. The deductible is your slice. If your deductible is $500 and you file a claim for $3,000 in damage, you pay the first $500 and the insurer covers the remaining $2,500. Sounds simple, right? Here's where it gets interesting. There's a scenario that catches almost everyone off guard the first time it happens to them. And it's this. What happens when the damage is less than your deductible? Let's say you have a $1,000 deductible on your car insurance, and you get a small dent that costs $700 to fix. You'd think, great, I have insurance. Let's file a claim. But since $700 is under your $1,000 deductible, your insurer pays zero. You're covering the entire $700 yourself. Filing a claim in this case wouldn't even help. You'd just be reporting an incident for nothing, and depending on your insurer, it could still affect your record. Now here's the part that decides how much you pay every single month, whether you ever file a claim or not. Your deductible and your premium, the amount you pay monthly or annually for coverage, move in opposite directions. Choose a lower deductible, and your premium goes up because you're asking the insurer to cover more of the risk. Choose a higher deductible, and your premium goes down because you're agreeing to shoulder more of the cost yourself if something happens. It's a trade-off, not free savings. A lot of people pick the cheapest monthly premium without stopping to ask, could I actually afford this deductible in cash if I needed to file a claim tomorrow? Let's look at home insurance because it works a little differently. Your deductible on a homeowner's policy typically applies to property damage claims, things like storm damage, fire, or a burst pipe. It generally does not apply to liability claims, like if someone gets injured on your property and sues you. That's an important distinction a lot of people miss when they're reading their policy. Say a storm causes $2,500 in damage to your roof, and your deductible is $1,000. You'd pay the first $1,000, and your insurer covers the remaining $1,500. But here's where deductibles get tricky depending on what kind of insurance you're dealing with. Because health insurance plays by a completely different set of rules. With health insurance, your deductible usually isn't per incident. It's per calendar year. So if your health plan has a $2,000 deductible, you pay the first $2,000 of covered medical costs during the year. And after that, your insurance starts sharing costs with you, often through something called coinsurance, where you might pay a percentage like 20%, and your insurer covers the rest up to your plan's out-of-pocket maximum. This is very different from car or home insurance, where the deductible typically resets every time you file a new claim, not once a year. So now you might be wondering, how do you actually decide what deductible is right for you? Here's the mistake most people make. People often choose their deductible based purely on which option makes the monthly premium look smaller. But the real question isn't what's cheaper right now. It's, what could I actually afford if I had to pay this amount today, out of pocket, with zero notice? If a higher deductible would put you in a tough financial spot the moment something goes wrong, it's not actually saving you money. It's just shifting the risk to a moment you're not prepared for. On the flip side, if you rarely file claims and have savings to cover a higher deductible, paying a lower premium every month for years can add up to real savings. So to summarize, a deductible is what you pay out of pocket before insurance kicks in. Lower deductible, higher premium. Higher deductible, lower premium, but more risk if something happens. Auto and home deductibles usually apply per claim, while health deductibles usually apply per year. And the biggest mistake is picking based on monthly cost alone instead of what you could actually afford if a claim happened tomorrow. This isn't financial or insurance advice. Deductible rules and structures vary by insurer and policy. So always check your specific plan documents or ask your provider directly. So here's my question for you. Would you rather pay a bit more every month for a lower deductible and peace of mind, or take a higher deductible to save now and take the risk later? Drop your answer in the comments. I read everyone. And if this helped make deductibles actually make sense, hit like and subscribe, because next week I'm breaking down another insurance term nobody explains properly.